Hey everyone, and welcome to Yield Yearning. Today's topic? Investing. Look, let's face it, the world of finance can feel like a jungle. Charts with squiggly lines, guys in suits talking jargon, it's enough to make anyone want to bury their money under a mattress. But guess what? You don't have to be a financial wizard to be an investor. This video is all about giving you, the investing newbie, the tools and confidence to take that first step. We'll crack the code on basic concepts, set you on the path to achieving your financial goals, and maybe even have a little fun along the way. So, buckle up, Buttercup, because you're about to become an investing rockstar. 1. Understanding the basics of investing. Let's talk about investing. It might sound complicated, but it's actually a way to put your money to work for you and grow your wealth over time. Imagine it like planting a seed. You invest some cash, your seed, nurture it with patience and smart choices, like watering and sunshine, and hopefully, it blossoms into a beautiful money tree. Unlike simply saving your money in a bank account, which keeps it safe but earns minimal interest, investing offers the potential for higher returns. But here's the catch: just like a roller coaster ride, investing can be exciting, but it also comes with some twists and turns. There's a chance your investments might not perform as expected, and you could even lose some money in the short term. That's why understanding the basics of investing is crucial before you jump on the investment roller coaster. Here's a breakdown of the key differences between saving and investing. Saving, this is your safety net. It's about keeping your money readily available for short-term goals or emergencies. Savings accounts offer low risk and guaranteed access to your funds, but the interest rates they typically offer are also quite low. Investing, this is about growing your wealth for the long term. You're essentially buying a piece of ownership, like stocks, or lending money, like bonds, with the expectation of earning a higher return over time. This comes with the potential for higher gains, but also the possibility of losses. The key takeaway is, saving is essential for building your financial foundation, while investing can help you reach your long-term financial goals, like a comfortable retirement or a dream vacation. 2. Setting financial goals. Alright, so where are you headed with this investing journey? Are you dreaming of that picture-perfect vacation to Fiji, complete with a swim-up bar serving tropical cocktails? Or maybe your vision is a bit further down the road, sipping margaritas on a beach somewhere, enjoying a comfortable retirement after years of hard work. No matter what your goals are, having a clear roadmap is crucial. Why are goals so important? Think of it like planning a road trip. If you know your final destination, Fiji, you can choose the most efficient route. But if you're just winging it, you might end up lost in the wilderness, financially speaking. Setting clear financial goals helps you determine the investment path that's right for you. Let's break it down by time horizon. Short-term goals, 1 to 3 years. Maybe you're saving for a down payment on a car, a dream vacation, or a wedding. For these closer timeframes, you might prioritize lower-risk investments that offer easier access to your cash. Think of them as the scenic route on your road trip, enjoyable and with potentially fewer bumps, but it might take a little longer to reach your destination. Examples of lower-risk options for short-term goals could include high-yield savings accounts, certificates of deposit, CDs, or short-term bonds. Long-term goals, 5+ years retirement, a child's college education, or buying a dream home are all examples of long-term goals. Since you have more time on your side, you can potentially tolerate more risk in your investments for the chance of higher returns. This allows you to take the highway on your investment journey, potentially reaching your destination faster but with the possibility of encountering some bumps along the way. Examples of investments suitable for long-term goals could include stocks, stock mutual funds, or ETFs, exchange-traded funds. Remember, your goals are unique. The key is to figure out what you're working towards and choose an investment strategy that aligns with your desired time horizon and risk tolerance. We'll delve deeper into risk tolerance in the next section, so stay tuned. 3. Assessing risk tolerance. Investing involves a little risk, but how much risk are you comfortable with? Are you a thrill seeker who wants to ride the investment roller coaster in the front seat, or a cautious captain who prefers a smooth sail? There's no shame in either. Knowing your risk tolerance helps you choose investments that match your comfort level. Alright, we've talked about goals, but there's another key factor to consider before diving into the investment pool: risk tolerance. Imagine you're at an amusement park. Are you the thrill seeker who jumps on the heart-stopping roller coasters, or the cautious captain who prefers the calmer carousel ride? Your risk tolerance in investing is similar. It's about how comfortable you are with the possibility of your investments losing value in the short term. Here's why risk tolerance matters. Different investments carry different levels of risk. Stocks, for example, offer the potential for high returns, but also have the potential for significant price fluctuations. Bonds, on the other hand, are generally considered less risky, but also tend to offer lower returns. Knowing your risk tolerance helps you choose an investment portfolio that aligns with your comfort level. Let's explore some common risk tolerance profiles. Conservative investor, you prioritize safety and security. You might be comfortable with lower potential returns in exchange for minimizing risk. Think of this as the calm river cruise of investing. Investment options for conservative investors might include high-yield savings accounts, certificates of deposit, CDs, or investment-grade bonds. Moderate investor, you're willing to take on some risk for the chance of higher returns. You might be comfortable with a mix of investments, balancing some riskier options with more stable ones. This is like taking the scenic route on your investment journey, enjoying the potential for growth while keeping things somewhat smooth. Moderate investors might consider a mix of stocks, bonds, and mutual funds that offer a balance of risk and reward. Aggressive investor, you're comfortable with a higher level of risk in pursuit of potentially higher returns. You might be more inclined towards stocks and other growth-oriented investments. This is like riding the investment roller coaster, exciting with the potential for big gains, but also with the possibility of steeper drops. Aggressive investors might focus on stocks, especially growth stocks with high growth potential but also higher risk. Remember, there's no single right risk tolerance. The best approach is to honestly assess your comfort level with risk based on your financial situation, age, and overall goals. There are also tools and resources available online to help you determine your risk tolerance. We'll explore some of those options later in the video. 4. Types of investments. The investing world offers a buffet of options. Stocks are like tiny pieces of ownership in a company. Bonds are basically IOUs from governments or corporations, promising to pay you back with interest. Mutual funds and ETFs are like investment baskets holding a mix of stocks or bonds, offering diversification. Don't worry, we'll explain that fancy word in a sec. Stocks. Stock types, go beyond common versus preferred stock. Briefly explain. Growth stocks, companies focused on rapid expansion, often with high price-to-earnings, PE, ratios and potential for high returns, and high risk. Value stocks, companies considered undervalued based on their fundamentals, offering potentially lower risk and more stable dividends. Blue-chip stocks, large, well-established companies with a history of stable growth and reliable dividends. Analyzing company performance, don't just mention financial ratios. Explain a few key ratios like PE ratio, stock price relative to earnings, price-to-book ratio, stock price relative to company's book value, and dividend yield, percentage of a company's profit paid out as dividends, and how they can be used to assess a company's health and potential. Real-world example, showcase a successful stock investment story. Briefly discuss a company that has performed well over time, highlighting how factors like consistent growth, strong financials, and a competitive advantage contributed to its success. Bonds. Bond types, expand beyond government versus corporate bonds. Briefly explain. Municipal bonds, bonds issued by local governments, often exempt from federal and state income taxes for residents of the issuing state. Corporate bonds, bonds issued by companies to raise capital, with varying interest rates and creditworthiness depending on the company's financial health. High-yield bonds, bonds issued by riskier companies with the potential for higher returns but also a higher chance of default. Factors affecting bond prices, go deeper than interest rates. Explain how factors like inflation, credit rating changes, and overall market conditions can influence bond prices. Bond ladders, explain the concept of a bond ladder as an investment strategy. Briefly discuss how investing in bonds with staggered maturities can provide a steady stream of income throughout retirement. Mutual funds and ETFs. Actively managed versus passively managed, elaborate on the differences. Actively managed mutual funds, funds run by professional portfolio managers who try to outperform the market by picking individual stocks. These funds typically come with higher fees. Passively managed ETFs, exchange-traded funds that track a specific index, like the S&P 500, and aim to match its performance. ETFs generally have lower 5, conducting research and due diligence. Alright, so you've got your goals in mind and you understand your risk tolerance. Now it's time to do your homework. Before you throw your hard-earned cash at the first flashy investment opportunity, you need to conduct research and due diligence. Think of it like planning a dream vacation. You wouldn't just book a trip to a random island without checking reviews, right? The same goes for investing. Here's why research is crucial. Investing involves a certain level of risk, but thorough research can help you make informed decisions and potentially minimize that risk. By researching companies, industries, and overall market trends, you'll be better equipped to choose investments with strong growth potential. Remember, the fidget spinner craze was all the rage until it wasn't. Don't be that mean. Here are some resources to get you started with your investment research. Financial websites. There are many reputable financial websites that offer company analysis, industry reports, and market news. Look for established websites with a track record of reliable information. Company annual reports. These reports, readily available online for publicly traded companies, provide valuable insights into a company's financial performance, future plans, and potential risks. Investment newsletters. Subscribing to a few well-respected investment newsletters can keep you informed on current market trends and potential investment opportunities. Pro tip: look for newsletters with a proven track record and avoid those promising unrealistic returns. Beyond online resources, consider these tips. Talk to a financial advisor. While not essential for everyone, a financial advisor can be a valuable resource, especially if you're dealing with complex investment scenarios. They can offer personalized advice based on your specific goals and risk tolerance. Learn from others. There are countless books, podcasts, and online communities dedicated to investing. Use these resources to learn from experienced investors and gain valuable insights. Remember, research is an ongoing process. The market constantly evolves, so stay informed and continue to learn as you grow your investment journey. By dedicating time to research and due diligence, you'll be better equipped to make smart investment decisions and achieve your financial goals. 6. Creating an investment plan. Alright, you've conquered the knowledge phase. Now it's time to translate that knowledge into action by building your personalized investment plan. Think of it like a treasure map leading you to financial freedom. This plan will be your roadmap to achieving your goals, outlining how much to invest, where to allocate your funds, and how to keep your portfolio on track. Before we dive into the specifics, let's address a crucial foundation. Emergency fund. Before you start investing, it's essential to have a fully funded emergency fund. This is a safety net of cash readily available to cover unexpected expenses like car repairs or medical bills. Aim to save 3 to 6 months' worth of living expenses in a high-yield savings account for easy access. Now, onto the core elements of your investment plan. At investment time horizon, this refers to the time frame you have to reach your financial goals. Are you saving for retirement in 30 years, or a down payment on a house in 5 years? Knowing your time horizon plays a crucial role in asset allocation. The asset allocation. This is the strategy of dividing your investment portfolio among different asset classes like stocks, bonds, and cash equivalents. The ideal allocation depends on your risk tolerance and time horizon. Generally, younger investors with longer timeframes can handle a higher allocation to stocks for growth potential, while those nearing retirement might prioritize stability with a higher bond allocation. Here's the don't put all your eggs in one basket principle in action. Diversification is key to mitigating risk. By spreading your investments across different asset classes, you reduce the impact of any single investment performing poorly. C. Regular contributions. The power of consistent investing is undeniable. Setting up automatic contributions to your investment accounts, even if it's a small amount each month, allows you to benefit from dollar-cost averaging. This means you purchase more shares when prices are low and fewer shares when prices are high, potentially smoothing out market fluctuations over time. D. Rebalancing. Just like your treasure map needs occasional updates to reflect changes in the landscape, your investment portfolio needs periodic adjustments. Rebalancing involves revisiting your asset allocation and buying or selling investments to ensure your portfolio remains aligned with your risk tolerance and goals. Remember, your investment plan is a living document. It will need to evolve over time as your life circumstances and goals change. Review your plan regularly and adjust as needed to stay on track towards financial freedom. 7. Seeking professional advice. Conquering the world of investing can certainly be a solo adventure, but sometimes having a trusty guide by your side can be incredibly helpful. Think of financial advisors like investment Sherpas. They're experienced professionals who can help you navigate the trickier parts of the mountain, ensuring you reach your financial peak. So, when might seeking professional advice be a good idea? Complex situations. If you're dealing with complex financial scenarios, like estate planning or inheritance management, a financial advisor can provide valuable guidance and ensure you make informed decisions. High net worth individuals. For individuals with a high net worth, managing a complex investment portfolio can be time-consuming. A financial advisor can take the reins, freeing you up to focus on other aspects of your life while they ensure your investments are aligned with your goals. Lack of confidence. Investing can feel overwhelming, especially for beginners. A financial advisor can provide personalized recommendations and ongoing support, boosting your confidence as you navigate the investment landscape. Here are some things to consider when seeking a financial advisor. Credentials and experience. Look for a qualified advisor with relevant certifications and a proven track record. Fee structure. Financial advisors charge different fees. Understand the fee structure up front and choose an advisor whose fees align with your budget and investment goals. Investment philosophy. Do your research and find an advisor whose investment philosophy aligns with your own risk tolerance and financial objectives. Remember, a financial advisor is there to guide you, not replace your own judgment. Do your research, ask questions, and feel empowered to make informed decisions about your financial future. In the descriptions are some resources to help you find a financial advisor. Ultimately, the decision of whether or not to seek professional advice is yours. But by understanding the benefits and knowing where to look for qualified advisors, you can make an informed choice that empowers you on your investment journey. Alright, investing newbies. You've just taken your first steps into the exciting world of finance. Remember, this is a marathon, not a sprint. Be patient, stay informed, and most importantly, have fun. Now, go forth and conquer your financial goals. If you have any questions, leave a comment below, and don't forget to like and subscribe for more awesome financial adventures.